Welcome to Certified Credit's Talk Data to Me podcast, where our FCRA certified experts help you tackle the latest regulations, emerging trends, and unique challenges of the mortgage industry with an intuitive, people-first approach. And of course, data. Because your business is built on more than just a score. Visit certifiedcredit.com for more information. Certified Credit helps you hone your best practices from lead generation to post-closing QC and everything in between.
This is Elizabeth Lang-Barton here live at ICE Mortgage Experience in Las Vegas with Susan Shaffer of National MI. How you doing, Susan?
Hi, I'm good, and thanks for having me.
Absolutely. I am so excited to have you back.
Me too.
This is PMI 2.0, so if you missed the first one, go back and see it. We recorded it at MBA National.
We did.
But today we're going to be diving a little bit more into the world of PMI. So Susan, let's just start for a refresher. If you haven't seen the first one or, they're not quite familiar with private mortgage insurance, what is private mortgage insurance or PMI?
PMI is exactly what you said, private mortgage insurance, but private mortgage insurance is used to protect the lender in the event of a default. So it's not insurance that is directly for the borrower, even though they end up paying for it as a part of their mortgage payment, but it's protection for the lender.
Okay. So when we're talking about this protection for the lender, a lot of the preconceived notions of a mortgage could factor in some myths around PMI. So whenever you get a mortgage, we know you have to have 20% down. And that's where PMI comes in if you don't have that 20% down.
That's right.
What are some of these myths around PMI or around mortgage lending that you guys really are looking to debunk?
Well, I think you hit the nail on the head with one of them being that just in general that a borrower needs 20% down in order to get a mortgage. And thankfully they don't. That's where PMI comes in. So for any conventional loan where a borrower is not putting 20% down, PMI is an option for that lender to put on the loan where the actual borrower then could put as little as 3% down.
Okay, so you have to put at least 3% down.
In most cases, yes. For a conventional loan, yes.
Okay, very interesting.
But 3 compared to 20 is quite a big difference.
Right, absolutely. It's a huge difference. So when we're talking about PMI, how is this calculated? I mean, it seems almost like when you look at that statement as a lender or as a borrower, it's like, oh, this number just appeared out of thin air. So how is it priced?
Yes, and I would say that the pricing for PMI has gotten a little bit more complex because there's more factors to it than there has been in the past. And what those factors would be similar to other things that a lender uses for general pricing. But it's going to be your FICO score, what percentage of loan to value you're doing. It's going to be your debt to income ratio. One borrower versus multiple borrowers can affect the price of MI premium. And even geography can impact the rate.
Really? That's very interesting. I mean, I'm thinking on the side of credit. So, you're talking about a lot of those things that you're going to find out throughout your credit score. What's that debt to income ratio? What is their credit score? And that's going to play an impact. But on the side of location, so how does location factor into that?
There are some areas of the country where the MI companies receive home price data, and some of them that may be suffering now and in some values, maybe those are deemed to be a little bit more of a riskier area for the MI companies to be insuring against. So there could potentially be a little bit more of an upcharge in MI in certain areas of the country.
Interesting. Okay. So, we're talking about these different areas. We're looking at data trends and, how that correlates with what's happening in that market. So I'm going to switch gears a little bit and talk about the mortgage market in general. So, we know that there was a big refinance that happened, throughout the past past year and a half or so. And now we're into this market where 6-7%, not going to necessarily refinance, but you may be throwing additional money at your principal. So on the borrower side, could someone potentially bring down their PMI or get rid of PMI with additional premium.
Yes.
Okay.
And that's a really common and a good question as it relates to PMI policies in general. So for our audience out there, most of you probably know that PMI auto terminates at 78% loan to value.
Okay.
And that date is predetermined based upon the original amortization schedule of the loan. And whatever month that falls on, by the time the loan reaches 78%, that is when the servicer has flagged that MI to be automatically canceled.
Okay.
But before that happens, if the borrower has made additional principal payments, say they've accelerated their payments and they're doing their own LTV calculation, and they figured out that they are at 80% or below, they can contact their servicer to ask for the MI to be dropped.
So the servicer will not automatically roll that off?
No, they won't, because the servicer isn't keeping track of additional principal payments. They only have marked that 78% based upon the original AM schedule. And that is under the assumption you're making whatever, say the payment's $600 a month, that they're making that same $600 payment every month without any extra payments.
Interesting. So, I mean, that one of the things that makes me think about is, we're talking about adding additional money towards that principal, and we're talking about the loan to value here. And we're saying, 78%, which is roughly that's 18, technically 18%. Rather than 20 that you would be looking for?
That's the auto termination point.
So if we're looking at that, and let's say I got an appraisal, and the loan to value ratio would then adjust to be more than that 18 or that 78%. Could you potentially ask for PMI to be taken off? Is that something servicers do?
Yeah. Potentially.
Okay.
So here's the caveat. Yes. But it's another good scenario because there have been, over the past couple years, a lot of areas where home prices have gone up, and maybe in your neighborhood, that a house a couple doors down sold for, a lot more maybe than what you bought yours for.
Right.
But what I would say as it relates to that, before any borrower pays for an appraisal, that they should contact their servicer first and ask what their requirement would be.
Gotcha.
And if they would accept an appraisal to drop the MI early. But of course, the appraisal is going to be at the expense of the borrower. Yeah.
I think that's really interesting too, because, let's say you got an appraisal for a HELOC. Because HELOCs right now are very common because, people are looking at it. I have all this equity I could tap into, or other, secondary mortgage products.
Yeah.
So if they get that appraisal, it's just interesting to know, maybe possibly they could use that to get rid of some of that PMI as well.
They could. And in the case if they were paying for an appraisal for a HELOC already, that they would have it, then they wouldn't necessarily be out any additional costs if the servicer would accept that appraisal.
Interesting. That's really, we're thinking a lot about the impact on the borrower here. Whether you're a lender or you're a servicer, a lot of this does go back to what's the impact on the borrower.
Yeah.
And something that we talked about on a previous episode, we talked about, credit refreshes and things like that, and how the new Fannie and Freddie loan level price adjustments are impacted by, that potential credit refresh. So we have a credit refresh, and then we find out that, oh no, the borrower has additional debts. The debt to income ratio is off, and then all of a sudden they're going to be paying more because of this loan level price adjustment. So how are you guys seeing that impacted in the PMI space?
Well, I would say that now, especially more than ever, once the 40% DTI loan level price adjustment takes effect, which is going to be for any loans delivered on or after May 1, that having the best MI rate available to your borrower is going to be important, especially for those DTIs where you're close to 40.
Right.
So let's say you're 38. You want to make sure that you're using, hopefully, a best execution technology quoting feature, whether that's in your loan origination software or a separate pricing engine. And having the best MI rate available may, in fact, keep that DTI under 40, thereby saving the additional loan level price adjustment that have just been announced. Yes.
Okay. And so I guess that kind of leads me to ask, how would a lender know? How would they know about, what's going to be that best case scenario?
Most lenders are using technology that allows them to run a best execution with all of their MI providers. And however many that ends up being for that particular lender, it may vary. But since we're here at ICE Technologies, Encompass, which a lot of the mortgage industry uses, does have a best execution feature called TQL, stands for Total Quality Loan. But a lot of lenders also price outside of that in Optimal Blue, which is a pricing engine for their investor pricing, but MI is also in there. So there's a lot of options. And if our listeners need to know any more of them, or you want to ask what you're using, just drop us a comment in the chat and we'll be happy to get that information
we'll
out.
Put something over there for you.
Heck yeah.
Susan will answer all of your questions. She's very good about that. I called her the other day and I was talking to you about, our situation where my husband and I are looking for a new home, and I'm going, well, one lender's telling me that my PMI is going to be this. The other lender's telling me it's going to is. How is that even calculated? And she's like, maybe we should talk about it on Talk Data. So here we are.
It's a good Talk Data to me topic.
It is. It is. Well, because I think when we talk about this from the lender perspective, everybody's doing it a little different. And so it's interesting to hear from your perspective as a professional how you guys are really executing on this. I mean, I think a lot about the services that integrate into Encompass. From our perspective, we have our Cascade VOE, our Cascade Alerts, and you guys are doing the same thing. You're integrating into the Encompass platform, which is why you're here presenting at ICE.
Sure. Yes, definitely. And in addition to Encompass, we are in most other loan origination softwares, probably similarly to certified credit.
I think that's one of the interesting things about being in a service that, yes, you might have the option of multiple providers and they might be in multiple platforms. So it really makes it important to find the right partner.
Yes.
And making sure that, you're with someone like a Susan who's going to look out for your best interest, or you're with someone like one of our reps who's going to look out for your best interest. All right, so Susan, we're talking a little bit about Fannie and Freddie, and that kind of leads us into a conversation about the secondary loan market. So with the secondary mortgage market, how does PMI impact that?
Well, sometimes lenders have borrowers that do have the 20% down.
Right.
And that is pretty common. But I would encourage all loan officers to take a look at pricing with that loan with 20% down, and then maybe change that LTV to 15% down with MI, and see how the pricing changes that the lender receives from the investor. So that loan will get better pricing on the secondary market because it has mortgage insurance.
Right.
And I know that may seem counterintuitive, especially for a borrower who has it in their mind that 20% down is the best way to go, and paying MI is an unnecessary fee. But in the long term, it can actually save the borrower money. And then they can put that additional down payment towards something, for their new home.
That's interesting, because I think a lot of us are taught, 20%, 20%, 20%.
Yes.
And then to hear that 15% might actually save you some money.
Yes.
And might also, help the lender go and resell that loan on the secondary market. And I know I know it's only a 5% difference, but that could make a huge difference when it comes to, being ready to be in that new home. I think about, on my side, we moved into our new home in 2019. It was a fixer-upper. It was an old home. And because we didn't put as much down, we had money to put into the house. So when our furnace inevitably broke, that winter, we were able to then go and purchase a new furnace, which might not have been possible if we had put a full 20% down, or, a larger percentage.
Yeah. And having money in an emergency fund is very important, especially for a first-time home buyer, because you don't know what you don't know about owning a home and the expenses associated with it.
Well, and even especially in this market, we're talking about a period where unfortunately people are losing their job. We're talking about a market where there's not as much security as there might have been, 2 years ago. And so whenever you have that emergency fund, if something were to happen, you have that money set aside, and your borrower isn't strapped for cash at the end of the day. They're in a more comfortable financial position.
Right. And that makes you look like a hero to your borrower as the loan officer who's presented them with an option that's going to save them money in the long term and hopefully allow them to have a cushion for maybe something unexpected or maybe something extra that they wanted to buy for their house. Yeah.
Right. Get that new sofa.
Yeah.
That's always the first thing. Get that new sofa.
Yeah.
Get the table.
Definitely.
So that's awesome.
And I would just add one last thing is that about 70% of home buyers that we surveyed in our Next Gen Home Buyer Report, that's at our website, that is free, is that 70% of Next Gen, meaning millennials and Gen Z, think that you do need to put 20% down.
That's crazy.
And we've already talked about a million ways that you don't have to, but it's just enlightening to see that that myth is out there.
Right. Well, and especially think 70%.
Yeah.
That is a high percentage. I mean, and if you're not working closely with a lender, that's what you don't know. So maybe whenever you are going out and you're marketing to your potential next gen borrowers, talk to them about those things, share education, connect with them. And I think that report that you guys offer in conjunction with Kristen Meserly is a great resource.
It has a ton of information.
You guys have that one. I know there's a new one that's going to be coming out shortly. There's a webinar, I think it's this week or next week, with Kristen and Ralph Remy at National MI talking about next gen women and how they're impacted by these financial changes, impacted by the housing market. And we know that the majority of homeowners that are next gen are women. And so it's so interesting to see that. And I really look forward to that report.
Yeah, we're happy to be putting it out. So, and Kristen does a great job in conjunction with our own training department. So, come check us out.
Yeah, go on National MI to find that report.
For sure.
I'll link to it in the show notes.
All right.
So everybody can access it.
Yeah, absolutely.
So, speaking of that, you guys have a booth here.
We do.
You're presenting
101.
at ICE. Booth 101. Love it. So that's such a good booth number.
Though we're an MI 102 because we already did MI 101, essentially.
Well, or is this 201?
This is 2.0, but if we were a college course, we'd be 102.
102?
Yeah.
Okay, we're
graduating.
I love it.
Yeah, we're
graduated.
in advanced PMI.
Ooh, advanced PMI. I love it. So you have a booth here. What are you guys doing at your booth?
Well, we hope that our lender customers and maybe some that aren't customers of ours will stop by and talk to us, and we can share information with them relative to what we have going on at National MI and what we think can help them and their loan officers.
Yeah. I love it. So if you are here at ICE, stop by.
Please do.
101.
101.
National MI.
Yes.
Or lovely certified credit booth here, or kiosk.
Yes.
Kiosk number 12. We are out in the hall. And Susan, thank you so much for being on Talk Data to me.
It was a pleasure.
So nice to talk to you. Have a good one.
You
Enjoy
too.
the conference.
Thanks for listening to Certified Credit's Talk Data to Me podcast. With over 35 years of industry experience, Certified Credit is your multifaceted mortgage solutions partner. Learn how our commitment to passionate service, innovative products, and superior technology create a more profitable and efficient lending environment for our clients at certifiedcredit.com. Certified Credit, more than just a score.